What's up, everyone? It's Karthik with MoneyVest. So an incredible rebound in the markets with the NASDAQ pushing up almost 3% on the day. We had the S&P 500 up over 2.3% and the Dow Jones pushing up over 1.7% or just under 700 points on the day. I'm sure everyone's portfolio is looking pretty because of the greenery that we witnessed across the board for most companies, most stocks, most ETFs pushing higher. So I'm going to break down everything you need to know from a fundamental technical analysis standpoint. As always, if you enjoy this video, find it helpful, make sure that you drop a like. We hit our 1,000 like goal yesterday, so I really do appreciate that. And share this video with a friend or a family member or somebody that you know that can benefit from this video, another investor trader in your communities. That would really help us out and in our growth here at the MoneyVest community. Now, you're also more than welcome to join our Discord if you want. I've been sending out a lot of alerts. I did pick up almost $30,000 worth of stocks on Monday and Tuesday. And this right here is my Tesla covered call, which is now up over 94%. So doing really well. This is something that I will be closing out tomorrow. And then we also took a trade on FNGU. That's the Magnificent 7 leveraged ETF, which is, of course, very risky. That's why I wanted to have a very contained risk, which we are currently up on close to $590 a share in the last couple of days here. As I've picked up about 50 shares. I bought majority of my shares on Monday at market open at $258. That was the big chunk of the order. And right now it's trading well over $334, up almost 11% on the day here. And of course, the long-term portfolio was up almost $13,500 here on the day. So again, if you want to get access to all the alerts, all the benefits, join our Discord, engage with thousands of experienced traders and investors from the world. Links going to be down below. Would love to have you on board. I send a lot of updates in our text analysis channel on a more regular basis every single day during market open. That gives you a bit of an idea on where we are from a fundamental technical analysis standpoint, as well as macro updates, volatility updates. Everything's going to be available with the link down below. We've got a few more spots open with that 16% annual discount that's available until the end of this month. So Dow Jones having its best day in over a year, jumping over 600, almost 700 points on the day. So very strong move to the upside. And this right here is a comment that I also wanted to address. In this video, I'm actually going to be sharing my entire playbook as well. Not the entire secret sauce, but yes, for the most part, I will be going over how I think about investing long term and also looking for tradable opportunities. Because, at the end of the day, it's really all about trying to understand the risk versus the reward in the market. A lot of people only really talk about the reward, the upside potential, but I feel like there is, that can give you a very delusional idea of the markets and not the full picture. I think it's really important for us to also understand that there is risks involved when it comes to investing in the markets. That's one of the reasons why we have to proceed with caution. And this person essentially commented, when VIX is high, it's time to buy is the most simplistic fail strategy. The VIX could always go higher. And to which I responded, not really. Once you understand it, it's very useful. That's like saying buying stocks is a failed strategy. Stocks could always go lower. Of course they can. And the idea is to understand risk and reward. And, when the VIX is high, it's time to buy has been a very successful strategy over the years because volatility in general tends to have a negative correlation, as we have discussed many times over on the channel, against the S&P 500. That doesn't mean that it can't go higher. Of course it can. I mean, we did see a stunning spike of over 180% Monday morning, but then it quickly crushed back down to just under 30 now is where it's at. The volatility, as it should, because the appropriate value should really be somewhere between 25 and 30, given that the S&P 500's drawdown has really not been as aggressive as what the volatility suggested it to be. So we're only really down 6% from all-time highs after the rally from today. We're still within the context of a pullback. NASDAQ is still in a correction by only 75 basis points, so down over 10.75% from its all-time highs. And the Dow Jones still within the context of a very small dip, down under 5%. But of course, a lot of individual stocks are still well within their correction to a bear market territory, Tesla being still in a crash, down over 52% from its all-time highs. So volatility in general obviously overreacted quite significantly, and as a result, we did do a lot of buying Monday, Tuesday. Again, I picking up a little bit over $30,000 worth of stocks from earlier this week. Now, a few more things that I want to address in this video is this. So I think it's really important for me to state this, and that is as presented in the data. And again, we are very statistical, very data-driven here at MoneyVest. I will show you exactly where my thought process comes from. The reason I do that is because I want to take emotions out of my own trading and investing decisions and also make it make sense for you, why I do certain things, right? It's not just kind of picking a number out of thin air or trying to time the market. No, it is every decision that I make is going to be backed by some data that I've looked at in the past and run some back testing or run some data analysis so that it actually makes sense. So as presented in the data, over a 5, 10, 15, and 20-year periods, when you are investing long-term, because we're primarily investing long-term here at MoneyVest, the probability for you to make money in the market is very high. As much as 86% to practically as high as 100%, right? So if you're investing as long as 15 to 20 years, the chances of you actually losing money is next to nothing because we've done the analysis for the last 200 plus years. And when you look at any 10, 15, or 20-year period, at any given point in history, you have made profit having invested in the markets, right? So time in the markets have almost always, in fact, I should say always, even though anything is possible, but I should still say always has made money in the market. Now, knowing that, does anyone know precisely where the market bottom is? No. So don't regret buying or feeling there's lower lows coming, so I should have waited. That won't work long term, right? So I got another comment the other day saying that I bought prematurely. I should not have bought on Monday or Tuesday because the markets are going to actually hit lower lows. And the idea is that you just don't know. You never know, right? Is the markets going to come down even further, or are we going to see a reversal from here? I'm sure there's a lot of technical indicators, and there's plenty of them that I use for myself that I look at to better understand the risk reward. But at the end of the day, I'm not trying to pick bottoms here. I'm trying to look for ranges where the risk reward is ideal and optimistic, and it's starting to look very favorable for me. So nobody knows where the market bottom is. So don't regret buying or feeling that there's actually lower lows coming, so I should have waited, because that is going to put you in a state of regret. And you're going to always hold back on buying when the markets are going down. And that won't work long term. So my strategy has always been this. I don't know when or where the market bottom will be. So I will keep investing consistently, trusting the process and sticking to the plan when risk reward is favorable and stocks and ETFs are cheaper. Can they get even more cheap? Yes, absolutely. Can they drop further? Yes, absolutely. Can the markets go lower? Yes, absolutely. Would that stop me from buying? No. Turn up the dial on your aggressiveness of how much you want to buy. For example, I've only deployed 15 to 20% of the cash that I wanted to deploy. And if we see this correction turn into a bear market, so if we see significant more downside, in other words, the S&P, continues to fall, the NASDAQ continues to come down further, the Dow Jones, gets rejected and starts rolling over again, then we are going to start buying even more. And then I'll be able to deploy more cash, 30 to 40% additional into the market. So that's really how I view things. And another really nice way to kind of think about this is in this strategy that I've laid out over here. When markets are at an all-time high, my cash exposure will fluctuate anywhere between 10 and 30%. I will continue with a periodic dollar cost averaging strategy into the market, whether it's individual stocks or ETFs or index funds, and then I will continue to hold and sell covered calls against my shares way out of the money with a really, really low delta as I continue to generate some income along the way as markets continue to move higher. Now, as the risk reward starts to become a bit more unfavorable to buy. Now, unfavorable risk reward is not the same as favorable risk reward to sell. Okay, I want to be very clear. An unfavorable risk reward to buy is not the same as a favorable risk reward to sell. Okay, so the lack of a buy signal is not the abundance of a sell signal. Just want to be very clear, because markets can remain overvalued and overbought longer than they can remain oversold and undervalued. Just remember that, because that's how the markets function. 72% of the times, markets continue to move higher. The VIX futures, if you look at the M1, M2 contango versus the backwardation, 83, 86% of the times, the markets are in contango, which is a stable upward direction, healthy market trend. So markets tend to be overbought, overvalued far longer and far more than oversold and in a correction or a bear market. We've studied the data, we've gone back, we've understood that data really well. So what I do in an unfavorable risk reward to buy scenario, when markets are pretty much at all-time highs, I look at my cash exposure, increasing it up to over 20, 25, closer to 30%. So I would increase the cash exposure that I have. S&P 500's valuation is something that I look at. I did a video on this today, so make sure that you do check out. There's a lot of historical data. We're going back over 60 years to really understand the average, the median valuation, what percentile we're currently trading in. The MoneyVest Index, which is in itself a combination of many different technical indicators that I've created myself. And of course, we got the volatility that we're looking at. The lower it is, the more cautious I need to be. The lower the volatility is, again, we look at the percentiles, we try to understand where VIX is trading relative to its historical medians and percentiles, and then we try to gauge, how cautious we need to be. We got a technical divergence in play. We got the Magnificent 7 index we have created on TradingView. We look at the technicals, we look at the overall valuations for not only the index, but the Magnificent 7 stocks as well. And of course, we look at VIX futures to understand backwardation. Because as soon as we hit a backwardation, as soon as the M1 contract is priced higher than M2, that is suggesting for elevated risk in the markets as well. So that, again, is an unfavorable risk reward to buy. And what I'm doing in that scenario is simply selling close to the money calls if I want to get rid of some stocks, if I want to de-risk a little bit, and I want to increase my cash exposure to get ready and get prepared for a potential pullback or a correction, which inevitably always happens, always comes, right? There's just no way around it. Markets are not going to keep going up forever. There is going to be an inevitable spike in volatility, and we're going to see the markets correct, and that is the trend for a healthy market. And when that happens, right, that's when we start moving into tactically into a favorable risk reward buy zone, right? That's the level where we are going to start feeling comfortable that the risk reward is getting better and I can start deploying cash. And that's when my cash exposure, as you would imagine, start to come down. Because what am I doing with my cash? I'm putting it into the market, right? I'm actually deploying money and I'm actually buying. And as a result, my cash exposure comes down from 25, 30% down to 10, sometimes even in single digits. And that's when, we're looking at volatility, spikes above 30. Again, we're talking about percentiles. What percentile are we trading in? MoneyVest index is less than 3, as we were, down to 2.85. S&P 500 valuations dips below 20. I think on Monday, pre-market, when it was trading, at those lower levels, we did drop below 20 on the valuation here. And we're looking at technical divergences, the Magnificent 7, Mag 7 valuations, and again, the VIX futures should be in contango for us to understand that selling pressure is starting to get exhausted. And this is literally just scratching the surface here. This is quite literally tip of the iceberg, because there's a whole list of a lot of other indicators that I like to follow as well, from a macro perspective, from a fundamental and technical perspective, to better understand the proper decision making for when it comes to trading and investing in the markets. The bottom line from all of this, really what I want you to know is we're trying to minimize risk and maximize reward. That's all it is. Like, my entire analysis all drills down to trying to understand how favorable or unfavorable the risk reward is in the markets to buy. It's not to short, it's not to buy puts, it's not to sell, get out of the markets and move tactically into safety. I don't try to time the market in that sense. Okay, I'm only looking at buying opportunities and when is it unfavorable or favorable to deploy capital. That's primarily what I do, because I am at the core a buy and hold investor with the potential to trade options and swing trade along the way as well. So that right there is a little bit of an understanding of how I view the markets and how I approach the markets, looking at different metrics here. And moving forward, so this right here is the current state of the market. So we just printed a higher low on the QQQs on a 30-minute time frame, and a breakout close to 449 or above that number will confirm a quote-unquote higher high as well, which could be the beginning of a potential trend reversal. So this is the current structure of the market. We're still very much in the context of a downtrend. So if I highlight that downtrend here, you'll notice that this right here is the overall downtrend, and the higher low was essentially this right here. So that's the first one, and the second one is right over there. So that is the higher low that we just printed on the markets today. And the resistance that I'm talking about is going to be right over there. That is 449. We will find out if the resistance will hold and how much strength this rally has towards the power hour. I posted this, I think, a couple hours before markets closed. This right here was a zoomed in version. We're at the inflection point. Can we break above 449 and make a higher high? If we fail to do so, expect a double top. And again, if you come over to where we are with the index, it looks like after hours we're starting to break out above 449. So we actually got rejected. So if you come over to the 5-minute chart, you'll notice that this is exactly the zoomed in version that I posted on our Discord. We got rejected here. Yesterday, there was a lot of chop in and around those prices. And then, of course, intraday, we saw over a 3% sell-off, almost a 4% selling pressure for QQQs, and then a nice little recovery on the day, up over 4%. And looks like after hours, we are starting to break outside of 449, almost at 450 now. So if you combine the after hours move and today's gain, we're up almost 3.5% on the day today. So that's a very, very nice move to see. Now, this right here is what I'm really trying to solve, okay? And this is the biggest problem, in my opinion, for retail traders, and the lack of understanding or knowledge, and really mostly trading or making decisions on emotions is what creates this sort of void when it comes to investing returns long term. So what you have over here on this chart is Monday morning. That's it. This is Monday morning from this week when volatility spiked to well over 60. Retail cumulative imbalance throughout the day. There was a significant amount of selling pressure. As you can see throughout the morning, we saw a significant amount of retail sales from retail traders and investors. And again, who was buying all that liquidity? Who was buying all those shares? Institutional investors who were net buyers on Monday and took advantage of this well-engineered sell-off. So this is where we come in. That's why I ask you guys to share this channel. If you enjoy the videos, if you find them helpful, please do share with other retail investors and traders in your community that can benefit from this understanding of this knowledge that when markets are down, when volatility spikes, those are clearly buying opportunities for us. I mean, that's where the risk reward is very favorable, and you have to push the buy button during those days. Can the markets go lower? Absolutely. We just don't know where the market's going to bottom out, but not taking advantage of those deals and all those opportunities can be detrimental to your long-term investing success. And worse, if you're selling during those days, it can be even further really bad in terms of long-term performance. So that's all I'm asking. Please do share, with other retail investors, traders that can benefit from the value of these videos and our community as well. I would really, really appreciate that. Okay, so this is the day, folks. Incredible amounts of green across the board. Needless to say that it was quite aggressive. Apple pushing up over 1.5%. We had NVIDIA up over 6% on the day. Microsoft over 1%. Google up over 2%. Meta up over 4%. Amazon up over 1.7%. Tesla also rebounding. So all Magnificent 7 companies pushing up, with majority of semiconductors. In fact, all semiconductors and chip stocks pushing higher. Software, we got software applications. We got healthcare, financials. We got energy, industrials, real estate, basic materials. Utilities, probably the only sector that was down, for the right reasons, because this was one of those days where you are not playing defensive, you're very much on the offense, and liquidity flooding out of utilities and staples. For the most part, consumer defensives, you'll notice Coca-Cola, Pepsi slightly down, and then moving into some of the riskier assets once again. So markets were very much risk prone on the day as opposed to being risk averse. This right here is going to be the flows from ETFs, and you can see the bond market doing not so great. So there's a lot of liquidity flooding out of the bond market over to other parts of the market as well. And this is the exact opposite of what we have witnessed over the last 3 to 4 days as markets were positioning more defensively. They're moving more towards safety. On the day today, of course, markets being very aggressive and moving out of fixed income over back to large cap and small cap, mid cap equities as well. So Bitcoin also being one of the riskier assets, pushing up to almost $60,000, and Ether up a little bit over $2,500 here. The 30-year bond auction took place. We had a yield that was awarded at 4.314% on the 30-year bond, and a bid to cover ratio of 2.31. This is very similar to what we witnessed for the 10-year bond auction of 2.35. So that continues to be a little bit more stable as the demand is still strong, but the yield awardeds are coming down for the treasuries, although I think we did kind of tick higher a little bit for the 30-year treasuries. Now coming over to jobless claims, 233,000 is what we printed, which is 17,000 less than the previous revised number of 250,000. So this kind of restored a little bit of that confidence that, okay, we're not really seeing that many people file for jobless claims. Even though unemployment rate, tick higher a little bit to 4.3%, we are not seeing as much in initial claims as the prior number, 250,000, and that is actually a decline week over week to 233,000 here. This right here is the current VIX term structure, and you'll notice that we are still well within a backwardation. And what that simply means is the M2 contract, which is over here, it's the September contract that is priced lower than the M1 contract, which is going to be this one. And eventually it's going to expire, and it's going to actually move to its spot VIX value. And that's really where we are at the moment. We still have, I think, 15 days to expiration because I think they expire on the third Wednesday of every month. But the bottom line is that we're still in negative number here, the difference between M2 and M1, and that is backwardation. As soon as it moves into contango, that's going to be a healthy, stable market functioning in an upward trajectory once again. And that happens for over 83% of the times, and 16% of the times we actually are in backwardation, which is where we are right now. So this right here is some recession fears. So over the next 12 to 18 months, are you preparing for a recession? Now this back during the third quarter of 2023, so just about a year ago, we had over 80% 80%, and this is based on, I believe, some of the earnings calls data. So this is from CEOs. A brief and shallow U.S. recession with limited global spillover were some of the things that I think they were expecting. And now 70%, as of the third quarter of 2024, 1 year later, 70% do not anticipate a U.S. recession. However, there's been a huge spike in the search term recession in the U.S. on Google search here. And this right here, we searched, all the way up to over 100 during that spike when the market's, volatility here spiked. There was a lot of correlations drawn. In fact, I also looked at my channel views and also the term volatility, and those are also very similar. And when I looked at the VIX and I looked at my channel views, they were also almost exactly identical. So we had a spike in a lot of things on Monday. Volatility, a lot of volatility products. And of course, the channel views, the search terms, everything just shot up. It was quite a crazy morning, Monday morning, which is going to go down in history as one of the most volatile mornings for the U.S. markets. Now, this right here is also references to economic downturn on earnings calls, and you'll notice that it has continued to come down over the last few quarters. And you'll notice that this right here was, of course, the Q3 2023, which we did witness quite a significant. Actually, this right here was Q3 2023, and now it's come down to really, really low levels. So for the last couple of years, we have seen a significant drawdown in the overall term recession on earnings calls. So CEOs who are at the cusp of knowing most about manufacturing, supply chain, production are not really that worried about a recession in the US. This right here is also actually quite crazy data. So this was posted by Leonardo on X. What if you invested in the S&P 500 every time the US news channel CNBC reported that the stock market was in a turmoil? In that case, your average return after 1 year is equal to 40% with a win rate of 100%. This is going back as far as 2010. This is crazy. This is almost 15 years worth of data. And every time CNBC mentioned markets in turmoil, the markets have been green 1 year later. The forward returns have been absolutely incredible for the markets with 100% win rate. Absolutely incredible. Percentage of times it's positive. 1 year return, 100%. And 1 year return of 40% on average. Incredible return here. Now coming over to the markets again. So one of the things that I really want to discuss here is the overall trend of QQQs and S&P 500. So we are still well within a context of a lower high and lower low. So I think it's really important for us to keep track of the technicals and understand that while today was a very green day and an absolutely amazing ripping rally here on the day that we witnessed, we're still not clear out of the woods, or I wouldn't feel comfortable kind of sharing that, guys, we're back to all-time highs, or we're on our way to back to all-time highs. It's a huge reversal. Start buying. And the reason for that is because we do see dead cat bounces. We do see technical rebounds. We do see some type of bull traps getting formed in a downtrend, and we are very much well within a downtrend at the moment with these lower highs and lower lows. So today's recovery, very nice, but we are once again coming back up to that resistance inside this red rectangle, kind of flirting with that same level that we were struggling to break out of yesterday and just a few days ago as well. So this right here was back as last Friday, we were struggled to break out over 449, 450, although after hours we are well over 449, but I would just keep a close eye at these levels tomorrow as being the last trading day of the week, and that is going to be that resistance to keep in mind. So we're still within the context of a lower high and a lower low, and the next target is going to be all the way up to 467 for QQQs. SPY also in a very similar trajectory. As you can see that we are still well within a lower high and a lower low. However, what I will point out and I'll update is that we did make a nice higher low. So that is quite interesting. That is new. That is also a beginning, or some of the earlier signs of a technical rebound or a reversal. So that's good to see that we actually did form a higher low, and now we're coming up to that resistance for S&P 500. So that's going to be sitting roughly at around 53.20, and a breakout above this is going to put us on the map to potentially getting back up to this resistance at 55.63. That's going to be that next level to keep in mind, although maybe some resistance and supply at 5,400 as well. We got a little bit of a gap to also fill all the way up here. That's going to be sitting roughly around 53.90 to as much as 5,400, so about 10 points. But that is going to be that next target and resistance to watch for S&P 500. Coming over to Apple, and Apple here on the day up over 1.6%. Next resistance it's coming up to is going to be 215. If you come over to the 30-minute time frame for Apple, you'll notice that we are well within the context of a downtrend still. Although again, you would argue that we are making some type of higher lows, and it does start to feel a little bit more of a rising wedge as well, which is not always a bullish indicator or bullish pattern for stocks or for markets in general. So just keep a close eye on this. Support level is going to stay up at $206. We got a huge resistance to break out of at 215 for Apple moving forward, going into tomorrow and next week as well. Amazon still struggles at this resistance, so that right there is going to be that level on the day to watch. And of course, going into tomorrow, up over 1.8, almost 2%. So nice little rebound here for Amazon, and a breakout above this is going to put us on the map to getting back up to 173 for Amazon. Talking about Tesla, and Tesla here continues to sell off. Of course, consolidating sideways, but on the day, a little bit of a rebound from this green rectangle of 180s and 190s support. Resistance is going to stay up at $208. So that is the level that we're watching right now. And we're seeing a lot of consolidation for Tesla, as you can see that we're getting rejected here. And then, of course, one more support level that's sitting really well in the 190s for Tesla at the moment. So we're seeing some buyers stepping in at those levels, just consolidating sideways for the most part. NVIDIA, on the other hand, had a fantastic day, up a little bit over 6% on the day. But once again, I want to be very clear with where we are on the overall trend. And you can probably perhaps see that for yourself, that we are still making a lower high and a lower low for NVIDIA. So we're still well within the context of a downtrend. I really don't want really don't want anyone to make the mistake of thinking about this being the beginning of something great. And it could be. I'm not saying that it's not, but we don't have a confirmation yet. And the reason I say that is because we are still within the context of a downtrend. Let me just go over S&P 500 and I'll show you exactly what I mean, right? If you come over to the 2022 bear market, okay, let's just come back over to 2022. A lot of you guys who were investing back then a couple years ago, I'm not talking about the people who are beginners or new. You might not even remember or know what happened back in 2022, but this right here is the entire market structure. And just take a look at what investors had to go through in terms of volatility to really, really come out of this. So you'll notice lower high, lower low, lower high, lower low, lower high, lower low, a little bit of a higher high. So that was a huge fake out and then a more severe lower low. So if you take a look at how much we were down from all-time highs of well over 4,800, we all the way came down to being in a bear market down over 26%. And you could have made the case for a market reversal at any point during the sell-off, and I would not have argued with you because the markets did give us a lot of fake outs. This right here, just a simple fake out. This right here, making actually a higher high. This right here, another nice little rebound. This was for sure. I remember people just knew that this was the market bottom, and we are on our way back up because we just printed a new higher high. So boom right here and boom right here. Next thing you know, markets dropped another 15 to as much as 12%. So this right here, the entire sell-off was a little bit over 17, actually 17%, not even 10, 12%, over 17% sell-off. And we just had people freak out over a 9% drop in the market. Imagine 17% over 2 months in this consistent bleed lower and lower. So we just never know until we finally get that confirmation that there is significant divergence and markets are indeed making higher highs and higher lows and moving into an upward trend and a very healthy uptrending structure here in the markets. But this right here was quite brutal to not only trade but also to anticipate because of so much volatility and of course this consistent bleed lower in terms of that lower high and lower low. And for that reason, I just want to be very clear and don't want anyone to make the mistake to think that today's rally sort of changes anything. Yes, it was great. It was a nice little technical rebound, something that the markets very desperately needed. But at the same time, we're still within the context of a lower high and a lower low. So coming over to advanced micro devices now. So AMD, looking at a nice bit of a bounce here on the day, up almost 6%. This right here is going to turn back into a support now at 130. And resistance is going to stay put here inside this red rectangle, sitting roughly at around $150 a share for advanced micro devices. Talking about PayPal, nice little move up, 2.5%. We're still within the context of this green rectangle and that area of consolidation here. Next resistance all the way up to $68, $69. We got a double, triple top over there for PayPal. Visa also within the context of a downtrend, as you can very clearly see, lower highs and lower lows. Nice little support here at 250. and a huge resistance in the 260s for Visa as well. Talking about Meta platforms, so Meta here is one of the few companies that still manages to stay within a pullback, hasn't really breached that 10% threshold to come down to a correction yet. Everything else on this chart, especially for individual stocks, is in a correction or a bear market, or worse, in a crash like Tesla. But Meta here has still held up really well, up over 4% on the day, and still within the context of this consolidation here inside this yellow rectangle. So it's kind of like a neutral range coming up to that supply area at 540. Support level near term 458 down to 420 for Meta. Talking about Google, I actually picked up some Google and Microsoft yesterday. Good thing I did, because we are starting to see a bit of a bounce considering how oversold we are on the RSI, the MACD, and the L3 banker oscillator, and we've got a massive support and area of demand here in the 150s. I'll be planning to pick up more shares if Google and Microsoft continue to drop further, and we're coming up to that resistance here in the 160s for Google, all the way up to as much as 174, 175 for Google as well. Talking about Microsoft, and Microsoft here also incredibly oversold, up over 1% on the day, coming down to a very attractive sort of buy zone at that support here for Microsoft, and resistance is going to stay put all the way up to 431. Refer to our 37 stocks and ETFs shopping list, which is also available for all the members for more buy zones and buy targets, light buys, heavy buys, aggressive buys, and fair value. So refer to that sheet, and of course do your analysis and research on top of that to come up with a nice strategy for individual stocks. And finally, if you come over to Netflix and NPHASE and Costco, Netflix here pushing up over 3% on the day, coming up to that resistance here at 635 to as much as 650. We got a very strong support at 596. And then finally, if you come over to Costco, nice little rebound up over 3.5%, coming back up to that resistance of almost 840. Support level is going to stay put at $786 for Costco. And then last but not least, we got NPHASE stock, nice little push of over 5% back up to 108. Massive support and area of demand here inside $95, $96. And of course, we got a resistance and that area of supply sitting roughly in the 130s, 140s, double, triple resistance for NPHASE at those levels. So hope you all enjoyed this video and a complete update on the markets. Make sure that you drop a like. I want to be very clear that we're not out of the woods yet. Yes, we had a nice little rally today, but we're still within the context of a downtrend. So be careful, be cautious. You don't need to go all in. Be smart about dollar cost averaging and how you want to play this market downtrend at the moment. And I will continue to update you guys both on YouTube and of course on Discord as well. If you want more real-time updates, alerts, and analysis and members-only private videos, as well as our MoneyVest platform, links can be down below. We'd love to have you on board. 16% annual discount is available until the end of this month. As always, happy investing. I'll see you all in the next video.